In 2020 alone, retail traders poured more than $250 billion into single-name options contracts. Researchers found retail options traders lost $2.1 billion in under 2 years, nearly $5 million evaporating every trading day straight into market makers' pockets. This isn't bad luck. Every mistake in this video is structural, and it repeats weekly. One trader thought he'd found a risk-free glitch. It cost him nearly 12 times his account. Another found a real software bug that let him borrow money that didn't exist, and made his losses 25 times bigger. One mistake, born from a confusing number on a screen, ended a 20-year-old's life. Here's exactly why these losses happen, and the 3 rules that stop you from becoming the next story. Mistake 1. The free money delusion. Believing you've found risk-free money is options trading's most expensive delusion. In January 2021, Reddit trader 1R0NYMAN deposited $5,000 into Robinhood and built a box spread, a bull call spread, and a bear put spread at identical strikes. On paper, a box spread is genuinely risk-free. Its payoff always equals the gap between the strikes, regardless of the stock's move. He believed he'd locked in a guaranteed $40,000 to $50,000 profit over 2 years, using $5,000 as collateral against a $300,000 credit received up front. What he missed, that risk-free math only holds for European-style options, exercisable solely at expiration. He'd traded American-style options instead, exercisable early by anyone holding them, any day. Within days, several short legs were assigned early. Robinhood was forced to liquidate the position at terrible prices, turning his $5,000 account into a debt of nearly $58,000, and banned box spreads immediately after. In an efficient market, any return that looks riskless is compensating you for a risk you haven't spotted yet. Mistake 2. Treating a bug as a strategy. In November 2019, trader U/Control the Narrative found a genuine flaw in Robinhood's system. Writing covered calls against margin-bought shares made the platform mistakenly count the premium collected as fresh buying power instead of collateral. He looped it, buy shares, sell calls, get miscounted credit, buy more, turning a $2,000 deposit into roughly $50,000 of buying power, 25 times the leverage the platform was ever meant to allow. He used it on short-dated, out-of-the-money Apple puts. They expired worthless. He lost $46,000. Others exploited the same glitch before it was patched. One claimed to turn $4,000 into a $1 million position. A bug doesn't change the math underneath a trade. It just makes losses arrive faster and bigger. Mistake 3. Trusting the screen over the mechanics. This next mistake is the most important lesson in this video. Multi-leg trades like put credit spreads are sold to beginners as defined risk. Your maximum loss is fixed at the gap between strikes minus the premium collected. True. At final settlement. But settlement isn't instant, and in June 2020, that delay had tragic consequences. Alex Kearns, a 20-year-old college student, had sold a put credit spread. The holder of his short put exercised it early, forcing him to buy over $700,000 of stock he didn't have the cash for. His account displayed a negative cash balance of $730,165. What the app didn't make clear, Kearns still held the spread's other leg, a long put guaranteeing he could sell those shares right back, nearly canceling out the debt. Instead, an automated system emailed him a margin call for more than $170,000 in the middle of the night. There was no phone line for options accounts, only automated replies. Alex Kearns died by suicide that weekend, believing he'd destroyed his financial future. The next trading day, the system resolved the spread automatically. The real balance was nowhere near what his screen had shown. His death pushed the industry to change how it displays options risk. Know exactly what your position does under every scenario, long before you're staring at a number like that alone. Mistake 4. Buying before earnings. Buying options right before earnings feels obvious. A big move is coming, so buy an option and profit. Real transaction data shows the opposite. Options bought before earnings lose 5 to 9% on average, and 10 to 14% on the most hyped announcements. The reason is implied volatility, the market's price on uncertainty. Before an earnings report, implied volatility inflates because nobody knows what's coming. The moment news drops, that uncertainty vanishes and volatility collapses with it. An effect traders call IV crush. For your option to profit, the stock must move enough to overcome that collapse, not just move the right direction. Because market makers price earnings options with real precision, it usually doesn't. You can be completely right about direction and still lose money because you overpaid for the move before it happened. Mistake 5. The zero commission fallacy. Zero commission does not mean zero cost. The real cost is the bid-ask spread. Weekly options average a 12.6% spread, and out-of-the-money contracts average 28% of the option's value. Small trades under $250, like exactly the size beginners place, average 23.6%. Build a four-leg trade like an iron condor, and you pay that spread 4 times over. A strategy with a genuine 35-cent edge per share can lose all of it, and more to $40 of spread cost before the stock even moves. Across every retail trader, that's over $5 billion a year in transaction costs, mostly captured by market makers that brokers route orders to for payment. The commission was never the real price. The spread was. Mistake 6, selling uncapped risk. A long option can only lose what you paid for it. A short, uncovered call has no ceiling, no limit to how high a stock can climb. During the GameStop short squeeze, the stock hit an intraday high of $483 on January 28, 2021. A trader who'd sold one naked $50 call for a $550 premium would have owed $42,750 to close it, a loss more than 78 times the maximum they could ever have made. This is a gamma squeeze. As a stock races toward a strike price, the market makers who sold those calls must buy more shares to stay hedged, pushing the price up further and forcing them to buy even more. Selling uncapped risk for a capped reward is a bet already lost the moment the wrong scenario shows up. Quick hit, pin risk. Pin risk catches sellers on ordinary trades too. Exchanges auto-exercise any option a cent or more in the money at the 4 p.m. close. But holders can still exercise manually until 5:30, even as the stock trades after hours until 8 p.m. A position that looks safely out of the money at the bell can get exercised anyway if news breaks minutes later, and you won't find out until Monday morning. Why this keeps happening? Why do capable people keep making these mistakes? Researchers gave students $25 to bet on a coin truthfully described as landing heads 60% of the time. Almost impossible to lose on with discipline. 28% went bust anyway. Only about 1 in 5 hit the maximum payout. Even a guaranteed edge gets destroyed by oversized bets and emotional decisions. Options trading is that same coin flip, with real consequences. The fix. 3 rules actually work. First, avoid options with under a week to expiration. They're cheap because price sensitivity peaks, and a small move can flip your position from safe to dangerous within minutes. Professional premium sellers operate in a 30 to 45-day window instead, where time decay is meaningful but that sensitivity stays low. Second, take profits early. Closing at 50% of maximum profit instead of holding for every last cent has been shown to raise win rates and cut drawdowns by getting you out before the volatile final days. Third, size every position at 1 to 3% of your account. Even a genuine mathematical edge will eventually wipe you out if one trade is sized too large. Discipline is what lets an edge survive long enough to work. Every trader in this video was capable enough to open an options account and confident enough to place a real trade. None lacked intelligence. They lacked respect for the mechanics underneath it. Early assignment, settlement timing, volatility collapse, and spreads that quietly outweigh the edge. Options aren't a lottery ticket or free money. They're a precise mathematical tool that punishes ignorance immediately. If this changed how you'll approach your next trade, subscribe for more breakdowns of the numbers behind the costliest financial mistakes.